Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks are mixed here as we head towards the close of a volatile week on Wall Street. Our very own Jared Blickery standing by with all the headlines. Jared.
Thank you, Josh. Yes, we are mixed today, and we are down for the week, not only in the majors, but some of the small caps, even the mid caps. I'll get to that in a second. First, let's check out the Dow, which is down about 300 points or 0.6%, a little bit off of the lows, which we had at 1 p.m. Eastern today. Here's the NASDAQ Composite looking at gains of about 1/3%. You can see we were highest on the day earlier in the morning, and we actually started out in the red just a little bit. And the S&P 500 largely flatlined here. We're going to call that break even as of the basis, the close yesterday. And the Russell 2000, that is down the most, 1.74%. And we've seen the most volatility this month from the small caps, from the mid caps. And speaking of the mid caps, here's the S&P 400 down over 1%. But what is positive this week, although it's negative today, is the micro caps. That would be the penny stocks. Here's a 5-day total there, still holding on to gains of about 0.5%. And we got to check out what the bond market is doing. And yes, we're going to get to some heat maps and show you what the storm assessment is looking like there. But for the 10-year T-note yield, and let's dial this down to an intraday, just about break even. The bond market is shrugging its shoulders here. 30-year down 1 basis point to 4.84% after some pretty volatile action in the bond market earlier in the week, but that has subsided. Here today, we are seeing energy up 0.9%. Not a surprise. We're seeing natural gas, crude oil, heating oil. Those are surging because of Fern. And then XLB is materials. That is a gold and silver trade. Silver, triple digits. It hit 100 per ounce. Gold is just shy of 5,000 an ounce. Meanwhile, we got financials leading to the downside, off about 1.33%. Industrials, utilities, and healthcare also in the red there. Got to show you what's happening in the NASDAQ 100. Microsoft, a bright spot here, up 4%. Amazon and Meta each up more than 2%. Nvidia up 1.5%. Alphabet, Apple, just barely in the red there. So is Tesla. And then Broadcom down, closing in on 2%. And we've got some green here. Let's show you what's going on in the software space, some of the bigger names. But we are seeing Oracle down about 1%, Palo Alto down over 1% as well. Want to leave you off on the Dow Jones Industrial Average, where we're seeing Caterpillar, that's down 3.5%. They're reporting earnings next week, and then Goldman Sachs also down 3.5%. But we're seeing some strength in some of the staples, which is what you'd expect due to the weather situation that we're going to talk about quite a bit here, Josh.
We sure will. Thank you, Jared. Appreciate it. Well, AI demand has long been a focus for investors to gauge growth catalysts for big tech, but Intel's latest quarterly results puts supply challenges in the hot seat. Stacy Rasgon, Bernstein Managing Director and Senior Analyst, joining us now to discuss. Dr. Rasgon, always a pleasure, sir, to see you. Let's dig into Intel. The stock is tanking here, granted, of course, after what was just a monster run, of course, into that print.
To be fair,
guidance
it's
relative
where
to
it was a week
expectations.
ago. It's where it was a week ago, right? So, I mean, it went vertical into the print. And you know, anytime that happens, you need a perfect kind of result. It wasn't perfect. So, it's, yeah.
Well, walk me through the print and the response. What do you make of it, Stacy? How much of this is about yields on 18A?
I don't know how that it's about yields on 18A. They're supply constrained. And frankly, they didn't say anything on this call that they didn't say on the last call 3 months ago. 3 months ago, they said, we're supply constrained and Q1 is going to be the worst quarter. Just people don't listen. So, and, you know, it's up 47%, or it was, you know, in the last 3 weeks, mostly on vibes and memes and tweets, right? And I mean, the problem is, you know, the people are getting very excited about the potential for a server cycle and strong demand, and it's here, but I mean, clearly they've had a pretty big misstep. They just don't have the supply in place to capitalize on it. You have to remember, 2 quarters ago on the July call, they took a massive, it was like an $800 million charge for accelerated depreciation for older. They were basically scrapping older tools and selling them off for pennies on the dollar because they didn't think that they could reuse them, and they didn't think they have the demand to justify keeping them. And so they clearly got that completely wrong, and now they've got to dig their way out of it. And, you know, I think if you're thinking about the things that people liked, like they did like, you know, the idea of a server cycle. They liked the fact that 18A process was ramping and the Panther Lake products on that looked pretty good. And there was some hope that we might see, 14 nanometer foundry customers. And, I guess all those things in theory are still there, but, I've got a big server cycle that they can't capitalize on because they don't have the supply, and they screwed up in terms of putting that in place. 18A is ramping, but, it's not ramping any faster than expected, and it's still early, and the yields are still bad. And frankly, I think the 18A ramp is impacting margins. The margin guide was weak. And then the hope for 14A customers, he said maybe we'll hear something second half of this year, first half of next year. But I mean, we're not going to see, even if they do, we're not going to see any revenue from that for years. And the CapEx would have to go out, which probably pushes the break-even point out. I mean, in general, you just have to remember this thing is a massive turnaround. It's a battleship. It doesn't move quickly. And I think I may have said this here before, like it took 10 years to break it. It's probably going to take 10 years to fix it. That's like end of the decade. And it's not anything different from what Lip-Bu's been saying, but I mean, people have to realize it's going to be a slog. And with a stock that's up 47% in 3 weeks on basically nothing, I mean, of course it's going to give some of it back. Like, yeah.
Lip-Bu, now you mentioned Stacy there. Now, he's coming up on his 1-year anniversary as CEO, I think in March. Yeah. What do you make of the job he's doing, Stacy? What grade do you give him? Does he have the right priorities and strategies in place?
Yeah, I actually think he's done the right thing. So you contrast with Gelsinger. So Gelsinger came in to a big turnaround and acted like Pollyanna and put up like ridiculously bullish targets and started hiring like crazy. He had to fire them all eventually. Like, so that was ridiculous. Lip-Bu is not doing that. Like, he got the cost structure under control, right? He's trying to simplify the organizations. They got way too many layers and nothing gets done. He's bringing talent on. He's trying to give customers what they want. You remember, he basically was one of the founders of SMIC. He was on the board for 20 years there, so he knows how a foundry runs. He ran Cadence, so he knows what the ecosystem needs. He has a bunch of startups. They're all customers of TSMC, so he knows what customers want. So he's trying to put that customer mindset in place, and he's trying to underpromise and overdeliver, right? Which is the opposite of what Gelsinger was doing. So those are all the right things, but it's going to take a lot of time. Like, he's got a lot of things that have to be fixed, and nothing gets done immediately. And frankly, the supply issues they're having right now, which probably a function of all this. They've got a lot on their plate. There's a lot going on. And the idea that something like this could fall through the cracks, I mean, it's horrible because they should be given they have their own fabs, they should be in a position to really capitalize on this. And they're not. And it slipped through the cracks because they've got so much other stuff going on. It's just going to be a slug. Yeah. But do I object with the job he's doing or at least the things and the initiatives that he's putting in place? No, they're the right things. They're the things that need to happen.
All right, so you got a market perform on Intel. Let's talk about when you have a buy on, Stacey. That would be Nvidia. Now, Bloomberg reporting, you saw this one. Chinese government has told companies over there, like Alibaba, yes, they can start to get ready for those H200 AI chips. You saw that headline. You saw that story. I guess, do you believe that story, Stacey? Do you believe that headline? The timing is interesting because I do see reports that CEO Jensen Huang planning to travel to China in late January.
Yeah, maybe. Look, so we hear these headlines all the time, like it's on, it's off, it's on and off. At a minimum for Nvidia, at least they took China completely out. So like if it takes longer than expected, it's not downside at least, and that was very smart of them. And fortunately for them, they've got so much demand right now that even without China, they've got plenty, right? They're selling everything they can make. At least from the U.S. side, it does look like they're going to be allowed to sell, and so like the bottleneck or the gateway at this point has been China. And if China releases that bottleneck, I'm convinced that there was a lot of demand in China for those parts. So they will be able to sell in China anything that they're allowed to sell. What that number is, I don't know. But whatever it is, it'll be upside from where things are right now because they zeroed it out.
Nvidia, I'll end here, Stacey. Nvidia, it's been moving basically sideways here for months. Yeah. Why is it moving sideways? And what are the catalysts, Stacey, that are going to move it higher? As a fan of the name.
Yeah, it's a great question. And it's funny, too, because you look at other parts of the space, like semi-cap and memory and all these things, they've all just been ripping. Why? Well, they're going to build all this great AI stuff. Like, okay, and that's justified. Like, fine, but for who? Like, who are they building it for? It's going to be companies like Nvidia. So it's been this very interesting divergence between these two groups. And in my opinion, that divergence is not sustainable. Like, one of them is wrong, in my opinion. So I actually do think that there is a potential for a catch-up trade because I don't think that the other parts of the supply chain can be doing as well as they are doing and have it sustain if it eventually doesn't filter down to the compute names. And even for Nvidia, they've even said it, like that the numbers are too low. And I mean, the stock is like really cheap. I mean, in terms of catalysts, I mean, look, you got earnings coming up, and they already talked a little bit about Rubin at CES. I think it's going to be a big cycle for Rubin this year. I've got GTC, their GPU technology conference in March at their up in San Jose, or Santa Clara. You'll start getting Rubin data points like coming out of the supply chain in the first half for the launch in the second half. And hopefully we'll start seeing some of the new models that have actually been trained on Blackwell. We actually haven't seen any Blackwell trained models yet. So hopefully when we see those kind of come out, that hopefully those models are good. But I do think there's enough catalysts coupled with hopefully like numbers finally like really going up and a valuation that is very inexpensive. I like Nvidia. I do.
Stacy, we will leave it there. Always great to have you on the show. Enjoy the weekend.
Yeah, you bet.
We'll turn to the broader market now. Strength in tech helped to keep the NASDAQ and the S&P 500 in positive territory. But one of the standouts of the week, small caps, getting hit the hardest here. Joining me now, we got Thomas Martin, Global Investments Senior Portfolio Manager. Thomas, it is great to see. Let's start with the small caps. They're not having a good day, Thomas, but they have been leading the charge, we know, in 2026. What do you make of the small caps? Do you like the pint-sized companies here, Thomas?
Well, it started back in November of last year when, tech had such a great run in 2025. And then there were some questions about the sustainability of that and AI, et cetera. And maybe people just got a little tired. And, people have been looking for the rotation into small caps and value for the last couple of years. And it always starts out with a few days here and there, and then it sort of peters out. And so far, November, December, January, we're seeing that that's a little bit sustainable. And as people look at, the outlook for 2026, and you look at the big, beautiful bill and the spending that can happen, and lower taxes, et cetera, this is good for small cap stocks, and they've underperformed. So there's a possibility that this has legs, but you've really got to have that economy continue to do well, and we're continuing to get good news on that. I think what you're seeing today is just inevitably with such a run, it's going to take a little bit of a breather.
Thomas, if you look at sector performance this year so far, it's interesting. So, energy, IC, and materials leading. Then you got staples, though, Thomas. Staples takes the bronze. I'm just wondering, do you see that as a possible concern, a potential yellow flag, that folks would be moving to play defense like that?
Well, it looks as though people are wanting to play defense, and it's just there's a range of ways you can do that, and you can do that with the value companies, and certainly the staples are one way to do that. But they're really just growing units at 1% or 0% or minus 1%. We've started to get maybe a little bit better news out of them, Clorox and Procter and Gamble, but it's not exciting. So it's definitely defense. And then if you couple that with looking at what's happening with gold and silver, which is definitely now it seems like a risk-on play just because they're up so much, but it is a defensive play when it comes to the overall macroeconomy and the level of debt that's out there and the concerns that there are in the marketplace for some sort of correction in financial assets.
How about tech, Thomas? Your thoughts there, just broadly, the sector is looking here. I mean, it's been moving sideways for months. You overweight tech, neutral? How do you want to be positioned?
Well, we think that you want to be overweight tech, and there's a lot of places to be in there that are good, and certainly the AI-related companies are the ones that are going to be the beneficiaries. We still believe that the earnings growth for 2026 is going to come from IT and those types of companies. And yes, it's decelerating, but it's still a leading sector in that regard. And as people sort of sort out what happens with AI, I think they'll come back to those same leaders that have been performing, and that is where the earnings are, and that is where you have to be to take advantage of the things that AI is bringing us.
On AI, Thomas, you say here, AI is still a driver both to the upside and downside. Walk me through what you mean by that.
Well, what we just talked about is the upside is that, there's a tremendous productivity that's available. We're at the beginning stages of the usefulness of the ramp in both consumers using it and then more behind the scenes, companies being able to use it in their own businesses and to make things more efficient and to grow their earnings faster. So, and you're going to need the microchips, you're going to need the data centers, you're going to need the energy. These are all places where we continue to think that you're going to have upside. Now, when you get to high valuations and strong performance, you're going to take a rest there. So when when people are favorable about it, it's a driver to the upside. And when people get a little nervous about it, it's a driver to the downside. So I don't think that, as a portfolio manager or an investor, you want to try and time that. So you're sort of stuck being involved in the longer term story. And so you're going to have to ride those ups and downs.
Let's end here on some picks, Thomas, where you see opportunity. Live Nation, now that stock hasn't really gone anywhere in about 12 months. You like it. What are the catalysts ahead there, Thomas?
Well, so what happened in 2025 was that the expectation was for about 15% adjusted operating income growth. So that's the income metric that we look at, and for that to be sustainable for a period of time. And what you had in the year was that you had lumpy concerts, really, and lumpy fans, and the growth decelerated. And you've had the stock re-rate. I mean, it's down about 27% or so since its high, although it's coming back and certainly is strong today. You've now got expectations at a 10% adjusted operating income growth, and that's certainly nothing to sneeze at. And I think that as that becomes recognized, and as we get the concerts booked for this year, which it looks as though they're on track to do.
Think we lost Thomas there, but appreciate, of course, his time and those picks. Well, coming up, health insurers faced a political firestorm on Capitol Hill on Thursday. We zero in on what this means for the future of the sector. That's next on Market Domination. To the Swiss Alps and back with markets, quote, pretty much even for the week. That's the review from President Trump as he slalomed through a host of geopolitical and market turbulence. Here's what he had to say on the way back from Davos.
Market reaction's been good. It was up very big today. It was up big yesterday. It's where it started. It's very close to 50,000 for the Dow. And nobody thought you could be breaking 50,000 during the first year. So we'll see what happens. No, pretty much even, right?
Ben Werschel with me now from Washington. Ben, what's the latest?
Yeah, so Trump isn't wrong here on the markets over this last week. When you look at the markets, the S&P 500 starting Friday at close till today, it's essentially a big U there, coinciding with Trump's time in Davos after he made some threats on Saturday about Greenland and imposing tariffs on 8 nations. Another indicator that sort of ends the week where it began after Trump backed away from these threats on Wednesday is the Europe-US trade deal. That seemed to be teetering earlier this week, and we just got formal news a couple hours ago that the EU is backing away from some retaliatory tariffs that they had sort of possibly we're going to implement in February. They've been talking about it since last year, but obviously we're center of mind after Trump issued his new threats there. So on those two factors, things haven't changed. Where they have changed, I think it belies what has been a really consequential week in U.S. foreign and trade relations. What we've seen is, rhetorically at least, a real shift from Canada and from Europe in terms of how they want to approach the U.S. The language they're using is essentially that the world order has ruptured because of this past week, and that a lot of foreign nations need to sort of figure out a way to go forward without the U.S. involvement. Canada has been really central to that, but this has been a widespread theme we've heard all week in Davos, but also in Brussels, but all around Europe.
And Ben, before I let you go, it has been a turbulent week for the U.S.-Canada relationship, fair to say, I think. How do you sort of just assess the Mark Carney and Trump relationship this week?
Absolutely, yeah. So this is significant both because of how central Canada has been pushing back on the U.S. in a striking way. You mentioned the Mark Carney speech. That was Tuesday in Davos. He talked about how a U.S.-led world order is, in his words, a pleasant fiction, and how basically smaller nations have to band together, kind of cut the U.S. out of the loop. Trump pretty predictably didn't like that and has had a sort of series of responses to that. Wednesday in his speech and in a post, he posted just a couple minutes ago, again, about Canada, that Canada's looking too closely to China and China's going to eat them up in the next year, is how Trump put it. So clearly this is a real tense situation. And this is also significant because Canada is kind of set to be the first test case of whether this new rhetoric we're hearing kind of has any basis behind it. Trump's and his team's critique is often that Europe and Canada talk a lot, but they have no leverage, so it doesn't really mean anything. But the U.S. and Canada are entering into negotiations this summer about the USMCA trade agreement. That kicks off in July, and that is what covers a sort of vast majority of the goods that travel between the U.S. and Canada. So if there is a real change here in the relationship, that's going to be one of the first times where we see it this coming summer in terms of what details of how those goods, how the trade rates on those goods change.
All right, Ben, thank you. Appreciate it.
Thank you.
Well, health insurers are back in the political spotlight with Congress grilling executives on Capitol Hill over rising premiums, denied care, and executive pay. For more, bringing in now Kim Monk, founding partner at Capital Alpha Partners. Kim, it is good to see you. So I guess first thought, Kim, just get your take on that hearing on Capitol Hill. CEOs are up there, these big insurers, they're getting grilled. Kim, you were watching. I mean, what did you make of it? What did you learn? Was it just theater, Kim, or no? You see real policy change coming?
Yeah, well, it was a long day for those CEOs. They had two very long back-to-back hearings where they had to field a lot of questions. On the one hand, it was what you would expect, Democrats staying on message, blaming Republicans for letting the enhanced ACA subsidy expire, and Republicans talking about how the ACA is unsustainable and Democrats built that system and we can't keep putting more money into it. I would say that it was surprisingly substantive in terms of the questions. A lot of discussions around cost drivers, underlying cost drivers. Some would say the insurers deflected, blamed hospitals and drug costs. Some talk of MLR, that's the medical loss ratio, and how the insurers are required by law to pay a certain amount for healthcare, 80 or 85%, and they're capped in terms of what they can have for margin and admin and marketing and things like that. But I think the other thing we saw was, from both sides of the aisle was some agreement over concerns about these big vertically integrated companies, about how that impacts consumers, about the PBM model, and particularly the overseas group purchasing organizations, CEO salaries. So it's a little bit weird because we're seeing this sort of populism where the right and left are coming together around some of these issues, and we even saw some Democrats defending the health insurers. So that was a little bit of a change from the past years.
You know who was also watching and listening clearly, Kim? Mark Cuban. I don't know if you saw this. Here's what Mr. Cuban posts on X. And when he posts, he gets attention. He says, "Too big to care. Make them divest all non-insurance assets." What do you make of that? Is Cuban right? I mean, could you ever envision that happening? And if it did happen, Kim, how would that happen from a policy perspective?
Yes, so I do follow Mark Cuban on Twitter, and he posts something like that every other day. He's very active. And he's not alone in saying that. Obviously, he has a vested interest himself because he has his own DTC platform, Mark Cuban Cost Plus Drugs. So he does have a financial interest as well. But other people are starting to talk about this. But, I think it's very challenging to go from we're concerned about about this vertical consolidation to breaking up the companies. There is a bill that's been introduced by Senator Liz Warren and Josh Hawley, a Republican from Missouri, that would require the insurers to divest their pharmacies. That's not really gone anywhere. I don't think they've attracted many co-sponsors, but maybe it gains traction if the left and right are saying something's got to give here. I've never seen Congress step in and break up big companies, though. I think that that's something that's difficult to do. And if you look ahead for the rest of 2026, I don't see a lot of legislating going on. We've got very tight margins on the Hill and a midterm election coming up, and Congress is probably going to finish this round of spending bills and be done. So the other avenue here might be, DOJ or FTC, sort of antitrust. That's not so easy either. FTC has been looking at PBMs. They do have some litigation around the PBMs and their insulin prices. But if you take a page from what's happened in big tech, they've been working for decades on antitrust issues there, and they really haven't had much success. So even if Trump sort of steps in and says, I want FTC, DOJ to start looking at these, big PBMs, vertically integrated companies, we're talking many years down the line. And even then, all these deals were approved by regulators at some point in the past.
You mentioned Trump stepping in, Kim, and the president has said he wants to meet with health insurance CEOs, wants to negotiate price discounts, like he's done with drug companies. How do you see that potentially playing out?
Yeah, well, they're having a hard time even scheduling it. Trump has been talking about this since before the holidays. Of course, he's been busy with international affairs and other issues. So we'll see if and when this pans out. I don't see it playing out in a very positive manner for the health insurers. The comparison here really is, the pharmaceutical industry and all the deals the White House has made with the 16, large drug manufacturers. The reality is the White House, the administration just doesn't have the same regulatory levers when it comes to health insurance. There are different markets. Obviously, health insurance is largely a domestic business, so you don't have the threat of tariffs, which has been a big lever for the pharmaceutical deals. You don't have the regulatory framework that you have with pharma, which are, IRA drug negotiations and some of those levers. So I suspect Trump will get fairly frustrated and potentially even bored if the insurers start talking about, hey, guess what? Our margins are already capped with MLR, and hey, our rates have to be actuarially sound. And at the end of the day, if costs go up, that will be reflected in the premium. So I don't see it necessarily producing, deals like we saw with pharma. And I guess the question would be, what next? Does Trump get frustrated? Does he order, HHS and CMS to take some sort of action? And then you have to think about, well, what levers does the government actually have when it comes to health insurance?
Final question, Kim. I know we were, kind of watching lawmakers, rain down fire on these CEOs and these big insurance companies. How do, just actual Americans, everyday consumers, feel about their healthcare plans? What does the polling say there? Do we have line of sight, or are most people as frustrated?
Yeah, I think so. Historically, the view is health insurance is terrible. Health insurers are terrible, but I like mine. I think we've seen that change. I saw some polling recently that suggested it's sort of crossed the midpoint, the 50% point of people who think the system is broken. And I think consumers are frustrated because they feel like they're paying more and more into the system, whether it's in premiums or higher and higher deductibles. And they're wondering what are they getting out of it? Because a lot of consumers are, facing delays, prior authorization, red tape, lack of transparency. So yeah, I don't know that we've reached a breaking point, but yes, there's definitely growing frustration. And I think just because the system is so complex, it's public, it's private, we have, private sector employers involved. It's really complex. So I think the lack of transparency and around how the whole system works is kind of frustrating for consumers, but also increasingly for regulators.
Kim, so great to have you on the show today. Appreciate your time. Thank you.
Sure. Thanks for having me.
Coming up, we take a look at how this weekend's winter storm could affect markets. Don't go anywhere. It was a massive winter storm is expected to hit the United States, and while the storm may bring heavy snow, we're looking at what it may bring from markets in today's Stocks in Translation.
Winter storm Fern is bearing down on a huge swath of America, and Wall Street is already pricing in the ripple effects. This isn't just weather drama, it's about where the economy is going to get pinched and where it gets a quick boost. And that's what we're breaking down on today's Stocks in Translation. First, here are 6 buckets of winners and losers. Start with energy and commodities. This is the heating bill trade. If the forecast turns colder or expands, demand is going to grow fast. Then, airlines is a biggie, and the most immediate disruption, cancellations, waivers, and the Monday morning mess when planes and crews are all out of position. Related is transports and delivery, the rest of the plumbing, packages, freight, trucking, and logistics when roads and hubs get jammed. And then there's you, the consumer, and the retail trade. What you need to stick it out is broadly winning, while what's nice to have is in the red. And you know the grid's about to get stressed, so for utilities and power, outages and restoration speed, they become the story. And finally, as the damage bill is tallied, all the wreckage will hit insurance and claims. Those who write checks for damages to homes, autos, and businesses, well, they're going to get hit too. So let's dig in and start with energy and commodities. And we're going to take a look at natural gas here. This is a forecast trade. Gasoline and crude oil futures are catching a bid, but natty gas has been up a big mover. It's up 70% this week, and that's a record going back to 1990. And gas tends to be a lot more volatile than crude oil. It's hard to ship extra capacity when it's needed most. Plus, guess what? Many data centers are powered with natural gas. So if consumers get stuck with big winter bills, that's going to put a bullseye on the AI trade this election year. Up next, let's take a look at the airlines. This is where disruption and frustration, they get real. Cancellations, waivers, rebooking costs, and the sneaky part is Monday morning, that cascade when planes and crews are suddenly found in the wrong places. Near term, this is about operational chaos. And longer term, listen for guidance on the earnings calls, cost, demand, and how the disruptions are stacking up. Okay, from people to packages, let's dig into the Dow transports, which we're taking a look at here. We've got a little bit of overlap with the airlines, but this board also shows you the supply chain ripple screen. Trucking, shipping, rail, and logistics. Those big green spots, that's CSX and Alaska Air, but they just reported earnings, so that's very company specific. The storm signal around the board, that red, that is the signal. Near term, this is about delays and bottlenecks, and longer term, it's about cost pressure, overtime rerouting, and service level issues. Now, let's get to you, the consumer, 70% of the U.S. economy. First, look at our retail names on this market cap weighted basis. It's clear that the big box retailers, the online giants, and the big home improvement names are largely holding up, maybe a few small losses. But you can see a bunch of red in the lower right where we have our smaller names. And I'm going to sort by performance here. Here you can see a lot of weakness in specialty and apparel. So you put it all together and it tells a simple storm tale. Necessities and stay-at-home names are looking a lot better than the nice-to-haves, at least in the near term. Next up, we got to talk utilities and power, another red board here. This is about outages and restoration. Near term, it's simple. You got ice, wind, and duration, or how long the storm lasts. These companies will be shelling out a lot of money for overtime and repairs. Longer term, it's what management teams say about the storm costs and grid investment over time. And now, let's take a look at who writes the checks when things break. And yes, that is property insurers. And this is where weather can turn into very big numbers. Short term, it's claims talk. Farther out, it's pricing power, reinsurance costs, and what management says about loss trends. So let's button this up and take a look at what you want to watch next. There we go. First, watch for any shifts in the forecast and track the footprint of the storm. A very small change can rewrite the winners and losers quite quickly. Next up, watch the outages and restoration pace. It's kind of obvious, but delays are not good for you and me. And you won't be able to turn on the news without being blasted with airline cancellation updates. If you can stay put, that's probably for the best. And watch where all these stocks open up Monday morning. Do they drag down the entire market, or is the news feed all AI hype again? Finally, as the week progresses, we're going to get dribbles and updates from insurers and shippers. That's the bill in dollars and time. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Now time for some of today's trending tickers, starting with gold, the precious metal glistening as it sets sights on its best week here since 2020. Gold climbing close to that $5,000 per ounce mark. Strategists cite a weaker U.S. dollar, expectations of Fed easing, large fiscal deficits, and fading demand for government debt. Goldman Sachs recently lifting its year-end forecast for gold to $5,400 from its prior outlook of $4,900. And speaking of Goldman Sachs, the firm changing its tune on Spotify, raising its rating on that stock from neutral to buy. Goldman seeing Spotify well positioned to capitalize on and benefit from rising generative AI adoption. The stock's risk profile also something Goldman says has turned more compelling amid recent weakness. And finally, a look at Applied Materials as Deutsche Bank upgrades that name from a hold to a buy. The firm raising its out-year estimates, knowing that it sees the company's current discount valuation to semi-cap peers as overdone. Deutsche Bank goes on to note that it sees potential for this valuation gap to shrink. Applied Materials has 30 buys, 12 holds, and 1 sell rating, according to analysts tracked by Bloomberg. Well, coming up, how options traders are navigating the current volatility in markets. That's next on Market Domination. Well, it's been a wild week on Wall Street, from geopolitics to the weather to earnings. A slew of catalysts are driving the action. Some of the big moves we've seen. We're digging deeper into how you can invest amid the volatility in this week's Options Playbook, sponsored by Tasty Trade. Joining me now is Scott Bauer, Prosper Trading Academy CEO. Scott, it's good to see you as always. You know, Scott, let's start on the small caps. I want to get your take there because they're down today, I know, but outperforming this month for sure. What do you see there, Scott? Any opportunities, hedging ideas? Walk me through it.
Yeah, you know, there was a lot of catch up, right, that the small caps had to do to the rest of the market. And we've seen that over the last several months. And we've gotten to a point now, though, Josh, if you look at historically, when the small caps or the Russell has outperformed the NASDAQ the first 2-3 weeks of the year. And that's happened 8 other times besides this year, going back about 100 years. The rest of the year, they have underperformed. Now, that may be different this year just because there was so much of a catch up, and so much of this is going to depend on what the Fed decides to do. So I love the run that we've seen in the small caps here, but just based on history here, might be a time to take some profits if you're still in that space.
Let's talk about tech as well, Scott. I want your thought there, because we see this kind of two-sided market, right? I mean, some chips are really working. Software is not working. Is there a mean reversion play there, Scott? Is it time for me to start betting on software?
Yeah, I think there really is a mean reversion here, and that may hit some of the small caps as well, because we've seen some of these stocks really get hit. This is all going to come down to, in my opinion, next week and the week after. You know, we've got Apple and Microsoft, Meta, Google coming out right afterwards. And if we start to see some of those reports where they're not pulling back on AI CapEx, guidance is decent, we could see a run back there. So I do think that, you know, we're kind of in this rotation right now where some of those stocks are ready for a pop again, and we could see that mean reversion.
Weather in the headlines here, Scott. I mean, front and center, we got a storm coming. Any plays stand out to you there? I mean, utilities, airlines, insurance, what do you see?
Boy, it's probably a little late to the game on this one right now. Obviously, earlier in the week, anybody that had gotten into natty gas or anything involved with that, boy, you're doing great here. I don't think that we're going to have a real big slowdown in terms of the airlines unless this storm lasts 2, 3, 4 days, which it looks like it's supposed to be pretty intense right now, but not last real long. So I'd be careful also buying into some of the utilities or even some of the insurance companies, ahead of this. I mean, we may see some claims here, but I don't know that this is going to be anything that is not expected at this point.
Finally, Scott, next week, big week. Got Fed, got big tech. What are you focused on?
Yeah, it's really not the Fed. I mean, what are they going to say? They're not going to change their attitude. They're not going to change their outlook right now. So it is really earnings. And like I said, it's the beginning of the big ones. And so what they say about CapEx in the AI space, that could really set the tone for how the market goes, not only just the rest of this earnings cycle, but maybe even for the rest of the year. And right now, I think the market is maybe expecting the worst. And if these companies come out and say, no, we're not changing how much we're spending, guidance is still strong, that could take us to new highs.
Scott, great to see you as always. Enjoy the weekend.
You too, Josh.
Well, flying taxis in the New York City skyline may soon become a reality. Vertical Aerospace unveiling its New York route plans for its Velo electric aircraft. Services are set to launch in 2028, subject to approval. Praz Subramanian is here with me. Praz, walk me through it.
Before we get into that service, I want to talk to you about the plane, the Velo, right? So it's an eVTOL, right? So it's electric vertical takeoff and landing. It's all run on batteries and electric motors. Has about a 100-mile range or thereabouts and can fly about 150 miles per hour. This thing can fit 6 people plus a pilot. That's the luxurious cabin configuration there, and all the luggage. This is a big deal, right? So they want to sell this Velo to actual airlines and other businesses. They don't want to operate it. They want to manufacture, and other, like let's say American Airlines and Japan Airlines are customers. They will use these things to ferry customers from place to place, before flight. So this is the business model. Urban air mobility, they call it. Looks very promising. It's quiet. It's clean. The question is, can they get certified in the next couple of years by 2028? That's the big target for them, and they think the sky's the limit once they can do that.
What are the New York plans exactly? Like, how are they talking about this? What are going to be the use cases?
So basically, the airlines want to be able to take people from the airport to Manhattan, right? As opposed to using Ubers and things like that. So this is the next way to do that. So they're talking about taking a flight from Lower Manhattan to JFK in 8 minutes, right? The cost would be about the cost of an Uber Black per passenger, right? So not, Uber Black, $150 for the whole car. Here, $150 or thereabouts per person. So it's not cheap, but it's not insanely expensive either. You want to get to JFK fast, you'll pay that, right? So that's the goal. Here you can see the map here: JFK, Newark, Teterboro, and eventually East Hampton.
And the business model, Praz, walk me through it. How do they make money?
Well, they're going to be selling the aircraft to their customers. They're partners like Japan Airlines and also American, but also the Bristow Group is a helicopter operating company. They manage fleets everywhere in the world. They would be their partner in New York City to fly those air taxis, from place to place. So they would sell their aircraft is what their plan is.
Who's their competition, by the way?
Joby's one big one. Joby Aviation. They bought Blade, and they have their own electric vertical takeoff and landing vehicles. But Joby, my understanding is they want to actually manage the aircraft, and you rent it through them, not the other way around. But I think Joby's going to partner with Uber, so then Uber could do that. So it all depends on how you want to. Do you want to own and operate, or do you want to just sell the planes? That's sort of the mix.
All right, thank you, Praz. Appreciate it. Coming up, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.